Hello, I'm Jeffrey Young, CEO of Deep Macro, and this is our Future of Finance podcast. Today, we have as our guest Amol Sarva. Amal was most recently the founder of and CEO of Knotel Inc., which is a global flex workspace company. He was also the founder of Peak, a mobile email device, and Virgin Mobile USA, among many other notable startups. So, Amal, welcome to the show. And first off, that's is that all you've done? Virgin Mobile?
Well, thank you for inviting me and including me. It's a pleasure to be with you. I'm an entrepreneur, so I've started lots of companies. Most of them haven't really worked out, so they wouldn't really be in the news. But yeah, I've had a few that really went great. So yeah, Virgin Mobile was like a big business, and
of course,
and I used to be an academic, but maybe that's why I kind of like you.
Well,
thanks for having me.
Yeah, no, thank you. But I've wondered, seriously, is there kind of a pattern? Knotel was about office space and real estate, and then some of your other previous ventures were in mobility. And personally, I and Deep Macro are very interested in both of these. I tend to think that there are some connections. What do you think? Or am I just kind of making this up? The mobile side and the real estate side.
There's a lot. Starting companies is a thing. Finding a problem and trying to create a solution to that problem, that's, a set of knowledge and behaviors, which is what my work has been. Over the years, of course, I have found myself in areas that are quite odd, whether it's enterprise software or neuroscience or whatever, to the casual observer. But, in all of these cases, I'm just trying to make something new, and in that sense, it's very similar.
Okay. So looking at office real estate, that has to be one of the hardest hit sectors in the economy from COVID. And it was undergoing a lot of changes before COVID. Can you tell us how you think office real estate is going to be different than how we have thought of it in the past?
Yeah, office, can you imagine? So COVID had a lot of terrible consequences for a lot of people. First and foremost, a lot of people got sick and a lot of people died. COVID was a terrible thing. I think I say was because we're sort of getting to the tail end of people worrying about their lives. But there are some businesses that had really intense stress from the global shutdowns. Our business, we ran hundreds and hundreds of offices for large companies. And there was a moment around March 13th last year where we just shut them all down, whether it was Japan or Germany, whether it was Paris, London, or New York. We shut them all down. And it was, wow. If you are trying to run a business with customers who are on a recurring revenue subscription kind of arrangement, and they can't use the product for 1, 3, 6, 9, 12. Wow. It was really tough for us at Knotel. But I guess, the bigger point for anybody who's working in that area is, real estate's going to change a lot. It's going to change a lot. And at different points over the last year, I had different opinions about that. There was a moment maybe 6 months ago where I thought, oh, well, all the offices in the world are going to be totally different.
Right.
I don't think that anymore, actually.
Okay. And why? What's the evolution in thinking there?
Over the course of this period, with the virus and the lockdowns, for a while there was a very popular school of thinking, and I was part of this. And I think I was wrong, actually. We'll see. But I thought, okay, well, health is a big problem, and it's going to be a big problem in a way that it really never was considered in the office business. After 9/11, the entire office business required security desks. Mm-hmm. And I think after COVID, we're going to have to redesign these offices to make them less susceptible to viral spread. So over this last year, there were many moments where I thought we will never return to the same office. Mm-hmm. At this moment, over these last few weeks, as I'm talking to doctors and epidemiologists, my view has really changed actually. The health part of it is probably not the main reason. Folks are going to be vaccinated. There's lots of vaccines. Everyone's going to get the vaccine, and that will not be the reason to dramatically change the way your office works. The reason, actually, not a health reason, it's an experiential reason. We all spent a year, like you and I, on video calls and all that. It's going to change people's patterns of work.
Hmm.
And no one is going to think, oh, the only way to succeed in life is to sit at my desk all day, 5 days a week, from 9 a.m. to 5. That's gone.
Right.
That I think is going to be a lasting change. People are going to change the way they work together. They will work together,
Hmm.
but they'll also work apart.
Right. And how, tell us about the together part, because people say, well, maybe it'll be, Tuesday, Wednesday, Thursday in the office, Friday and Monday not in or optional, or 1 week in, 1 week off. Some sort of, do you think that is it possible to summarize how you think the together part is going to work? Will the layouts be changed so that we're all in meeting rooms only, no desks, no offices, no separate offices?
Yeah, I think there is a great way to summarize it, and I think that for the like the equity investor community,
Hmm.
there is this like classic kind of way of thinking about the world. There is this community that's always like there are long term trends, and sometimes they're faster, sometimes they're slower, but these long term trends are true. So that's one group, and there's another group, which you know to put it unfairly, they say, oh, things are different this time, right? And so if you're hanging out with equity investors and you talk about bubbles and cycles and secular changes and whatever, like that is a very frequently well discussed topic. Is it different this time or is it the same as all the time? And there were moments over this last year where I thought, oh, you know what? Actually, this is a major change. This is like, it's different this time. It's different this time. It's different. Actually, I have changed my view on that. We have for 25 years or so, like since 1995 or so, we've been working more and more remotely.
Hmm.
And in December 2019, pre COVID, the data about Office was around 80% of your people are going to be in the office, but 20% won't on
Hmm.
any given day.
Okay.
What's it going to be like post COVID? Well, it went from 40 years ago, 100% of the people in the office to 80% 2 or 3 years ago, and it's going to be lower now. But that's a trend. And that line, I think, is going to keep on moving. I think what we're going to see in the post COVID workplace is people taking advantage of business travel and home and just all the other flexibilities that technology provides, and less like pure FaceTime. So, how's the office going to be different? Well, I mean, the main things you do when you're in the office that are super valuable is you connect with people. There's the mentorship and the collaboration and the serendipity and the innovation, all those kind of things.
Hmm.
So those will be a big part of what happens post
Hmm.
COVID for sure.
Okay. Okay. Um, I wanted to ask a little bit globally because you've got a lot of global experience. Knotel is very global, and I think that you feel multinationals have an outsized role in the office real estate market in terms of the spend and everything. So, um, has what you said, does that apply primarily to the United States? Is it kind of the same everywhere? Will Asia be much more in the office because they didn't actually get hit as badly by COVID? Uh, Sorry about that. um, or or will it? Are there differences that you can see globally?
Different markets have had different experiences with COVID on the extent to which they were closed. But if you buy my line that when we get to the other end of this thing, we're going to see that same through trend, that
Hmm.
same kind of broad flow. I think that means that in virtually all the geographies, we're going to see people with a more hybrid, more mixed, more like work from anywhere kind of setup.
Hmm.
And it is true that offices open, faster in China, Japan, and they'll open more slowly in the U.S. and in Europe. But I think we're going to be centering on the same mean.
Okay. Let me shift a little bit. I wanted to talk a little bit about crypto, blockchain in real estate, and whether they can be
Really?
connected. So, because on a previous podcast, we had Michael Saylor of MicroStrategy on, and he's very bullish on Bitcoin. One thing I asked him is if he could envision sort of a world where, say, 100,000 people all around the world owned a very small piece of a big office building in Manhattan through tokens or something like that. He wasn't so hot on the idea. He thought that basically Bitcoin was already basically a mini Manhattan. Why bother with the real side? What do you think? Is this one of the ways that tokens and blockchain can be used? I know that you've done quite actually a bit in this area.
Yeah. Well, I mean, blockchain, we're in the early innings. No one's done anything yet, honestly. I mean, it might be true that the Bitcoin total value is bigger than many of the stock markets in the world, but it's really just scratching the surface. I think that real estate is uniquely relevant to some of the features that the blockchain protocols provide. The real estate business is full of people who just don't tell the truth, lots of dirty data. So the incentives are kind of screwed up. They want to lie about things. The data is terrible. And I think it is like a really important core feature of the blockchain stuff, this like ledger, that you can verify. And we only have the one, we've got the Bitcoin chain where you have absolute reliable truth about, who's got this, who's got that. But now that that's invented, I think there will be applications of that to real estate stuff. I mean, in the real estate world, you more or less buy buildings with, just not enough information. And if you could totally rely on that information, the business would be bigger and it would move faster. So I think there's huge potential. But I think there were a lot of head fakes over the last 5 years where it was like, oh great, Ethereum, let's all just do real estate on Ethereum. It hasn't happened yet, but I think it will have a really big effect over a very long period. I mean, if you think back to 1995, 1994, the internet was going to have a big effect on real estate, like it would have an effect on everything. And the internet still has had only a very modest effect. So blockchain, I think, is that scale and that time cycle.
But overall, kind of narrowing the bid ask through better information is one thing that you're kind of painting through just kind of having a more accepted set of data about the real estate itself. Okay.
Yeah, I mean, when we were at Knotel, that was like our biggest area. I mean, Knotel had acquired and managed many hundreds of properties all around the world. And we were spending, in order to make sure we didn't make mistakes, we were spending 1% to 2% of the asset value to do those transactions. That's a pretty big number.
Sure.
So I do think that there is there's other opportunities. That you were asking about fractional ownership of real estate assets.
How about, I did want to get back to that. Maybe.
Yeah, maybe.
Is it regulatory, or is it just that there just isn't that big of a demand for it? There's enough money already going into real estate. Because I look at this as potentially opening up new pools of capital. But if,
Yeah, well, I mean, I'm with you that the Empire State Building is a wonderful, well-recognized asset that a lot of people would like to own a part of. And I don't know, you should just ask, like, well, what other tools are there for making that? The Empire State Building's owned by a REIT. I mean, you and I could make a trade tomorrow for like $50 and own a little piece. So I don't know, like, is the blockchain really helping? I think that my own conclusion was the irrevocable truth was like really important, and maybe I'm wrong, but I don't think the fractional ownership is the distinctive feature that makes the blockchain super relevant in real estate. I don't think so, because REITs exist.
Sure.
Joint stock companies and publicly traded equities exist. There's a lot of different ways to create partnerships, LLCs. I don't know. All that stuff exists. Blockchain is not the way to create fractional ownership.
Okay.
It has other advantages.
Right. Okay. Got it. So turning macro just for a second, let's think about right now the environment is, there's a lot of talk about inflation. The Fed has said that it's not going to preempt It wants inflation to run a little bit above its target. It thinks that it can do that for a certain amount of time and then turn it off. Real estate has traditionally been a hedge against inflation. And at least in the US, again, the shock from COVID was really severe. Um, do you think that generically, I mean, this is a good environment for real estate investment, especially commercial? In the US, is the winners and losers going to be just so differentiated that it's hard to talk about the asset class? How do you think that shakes out?
Yeah, that's an amazing question. So what happens in real estate is kind of your question. And as I speak to people in the business, across all the different layers of the business, there are a lot of really foundational questions, like existential questions, that I don't think we have consensus answers to. So there's a lot of like huge risks still. So for example, um, are cities a good idea or not?
Mm-hmm.
I can't believe that we're like sitting here talking about that, but that's a question.
Yeah.
I mean, there's people who are the proponents of like a Nashville or a Miami, and they're saying, forget about New York. Wow. Wow. I mean, the safest thing to invest in the world used to be Midtown Manhattan. Okay. So that's, and then the next question that you might ask that's still very much a point of debate is, well, what about these giant boxes, these office towers? Are people ever going to occupy those in the same way? Are they going to have 100,000 people in the Barclays building or in the Morgan Stanley building? Like, I don't know. I mean, maybe not. That's a really big question. I have an opinion on each of these things, but I could talk to 100 people and find an equally divided community on both. And then also, what about differential geographic performance? So if you're going to bet in real estate, you're always betting in a place, in a country, in a city, whatever. Well, do you want to bet in France or do you want to bet in China? Like, I don't know. I mean, that's actually a wonderful question. Back in 2003, between 2000, let's say 3 and 2008, great fortunes were made by betting on Asia,
right,
and against the US. Well, is that this moment? I mean, we bungled a lot of stuff just now.
Mm.
What? So there are some really big questions which would block you from going long, like heavy in commercial real estate. I think it's tough. And so there's a lot of questions floating around.
Okay, good enough. So we touched a little bit about the data issue when you were talking about blockchain. In liquid markets, stocks and bonds and currencies and stuff like that. In the last couple of years, data has really transformed investing. We used to say alternative data, and we don't really say that anymore because it's not alternative; it's standard. Pretty much everybody uses some form of data that used to be considered alternative.
Yeah.
I mean, real estate, you mentioned that it's kind of a slower, the techniques kind of change more slowly. What do you think? Are we going to get a much more data intensive kind of investment style in real estate?
I have been thinking a lot about that.
Mm.
And you and I have been talking about that.
Sure.
And it just makes sense that in any asset class, fast moving data should have a lot more to say, right? I mean, that's obviously true. But there are many things in the tech business when like there's a new innovation, some kind of new amazing whatever, where everyone will agree, okay, yeah, totally, robots will replace us, this kind of thing. Like, yes, okay, we know what's going to happen, but how will it happen? What's the sequence? What are the locks that need to be opened to get there? And so in the real estate business, so in the equities business, we're now like 30-ish years into the period where computers are outperforming people. Maybe, I don't know, some of the time, most of the time. In the real estate business, they're not. But surely, if you believe this vision, they will eventually. So why are they not doing it yet? And where could they do it first? Is the question that's on my mind. Real estate assets are larger. You can't buy one share most of the time. You got to buy the whole thing. They're riskier. There's debt in those deals, and you could lose all the money. You can't get a blend as much, right? It's on a street, on a block. It's in a place. That's a problem. They're not as liquid. They're slower to trade. So I could buy something, I can't sell it tomorrow. I might have to wait 5 years. Um, so there's a lot of issues that make it very different from the way equities work. And I think that because it's not fast and it's not atomic, I think the way that the artificial intelligence stuff works, it just can't get enough traction to become amazing.
Mm-hmm.
If you're a real estate private equity firm and you're going to look at deploying $1 billion, that means you're going to buy 10 to 50 buildings that are 100 to 20 million in value. Okay, 100 billions. And maybe you'll look at 1,000. You could have a team of 10 people and they could look at that. I mean, people can do it. So we haven't broken the old model to make those investment decisions in real estate. So I'm not sure yet. I'm still kind of wondering. And I see a couple of pockets in talking to friends that have had some success in the equities world. One of them is to watch valuation changes and to throw up flags so that the investment managers should know when they should pay attention to a building. So if you own 100, it's hard to be like super plugged in to all the 100, but you might appreciate if the software threw up flags and told you, hey, I should look at this. And then the other interesting one is when you're searching for a target asset, well, the world is big. I mean, there's a lot of properties in the world. And most investment managers in the real estate business, they just look at the stuff that comes through their email inbox. There's a broker who sent them something. That's a terrible way to do it. It suffers from all the kind of biases that make you screw up,
Right.
Much better if you could look at the entire map. And I think computers can help you look at the entire map, isolate the ones that are the most interesting, and then you can do the human powered work. So I think there are some pockets where data-driven investment managers can find advantage.
Okay, interesting. Okay, let me broaden it a little bit. I wanted to just ask kind of about your thoughts on just the venture capital market, especially relative to the times that you've started up many companies before. I'm just wondering if you had any comments about venture capital markets today. How do they compare versus the last couple of years? When you've been doing other things. Any thoughts that you have on that?
Yeah, that's a really nice question. I was reading Barton Biggs the last couple of days. He has a nice book, the hedgehogging book. And he has some nice charts in there from Swenson where venture capital massively outperformed every other class that those guys invested in at Yale. That book is from 2006, and it's from an interesting moment because 2006 is a few years after 9/11 and the dot-com bubble, but it's just a few years before 2008. And he's pretty opinionated, and he's like, prices are too high. And I guess Biggs, I'm not sure if this is true. You might know better than me. If he is a perma bear, is he?
I'd say that there was that element to the thinking. Yeah.
Well, I was reading the Biggs thing, and he makes a very good point that the entry price is very important in private equity and venture investing. And over the years, the entry price has been going up, but I think that it's not that far off from inflation. So if I was starting a company in 2000, I would have had the very first investment and the company would have been valued, somebody would have put in $1 million and they would have valued it at like maybe 4 million. If I was starting a company in 2010, they would have valued it at 8 million. And today, if I'm starting a company and I'm a credible founder, it's somewhere between 10 and 20, maybe it's 15. Right. So the entry prices for the very first stage of venture investment have been increasing, but I don't think it's insane. It's like doubled or tripled in 20 years. I mean, it's a little bit more than inflation, of course, but it's a category that's a little more well established. So what do I think about venture? I think that after a big crisis is always a great time to start a company. That's when Facebook was founded, shortly after 2006.
Right.
Always good. Yeah.
Okay. Very good. Well, that's actually a good, a hopeful note to end on. Thank you very much for your thoughts. It was really very informative. Thanks a lot.
Oh, too kind of you to include me. It's a pleasure.
The content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this material constitutes a solicitation, recommendation, endorsement, or offer by Deep Macro Incorporated or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction. All content is information of a general nature and does not address the circumstances of any particular individual or entity. None of the information constitutes professional and/or financial advice, nor does any of the information constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. There are risks associated with investing. Loss of principal is possible. Some high-risk investments may use leverage, which will accentuate gains and losses of securities or firms. Past investment performance is not a guarantee or predictor of future investment performance.